This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
So if you haven't been paying attention in 2017 to what's happening in investing, you might have missed it that growth has been ruling the roost again, much like 2015 and most of 2016, at least until the election in November. It has been FANG and the other big growth names, especially big cap growth, with the best returns. So even starting 2017, when some of us, including myself, thought that FANG might be done, we had a nice rally in value after the election results in some areas like the infrastructure and the industrials that are considered more value-ish. And then I thought maybe that would continue into 2017, but it hasn't. And everyone rotated back into FANG and the other big growth names. So growth has outperformed value by far in 2017. I don't know if you've been paying attention. I know us value investors are kind of want to ignore the growth story right now, but the Vanguard Large Cap Growth ETF, that's with the ticker VUG, that's up 14.3% year to date. So that's pretty hot because that's only a 6-month return there. While the Vanguard Large Cap Value ETF, and that's ticker VTV, that's up just 4.5%. So if you were thinking that value, is really lagging, you're not wrong. You're not losing your mind. It really did lag. I mean, that's a difference of nearly 10%. So you can really see where growth, especially large cap growth, has dominated. It wasn't really until 2015 that growth actually really took off. If you chart those two ETFs I just gave you over the 5-year period, you can see they're kind of moving in tandem up until 2015. Both were on the rise, coming out of the Great Recession. And then 2015 was the turning point for the growth stocks when the FANG really started to take over. And then over the last 5 years, the large cap growth is up about 100%, that ETF, the VUG, and that compares to just a 74% return for value. So while I'm not knocking the 74% return at all over 5 years, that's not so shabby. It is definitely trailing that 100% return that we saw in growth. So the question on a lot of people's mind has been, when does value get back in the game? It's never been that growth has totally dominated, completely over long periods of time. It has had these streaks, which it is in one right now. But I've been watching to kind of see when we might see a return to value, because I know a lot of you have been thrown in the towel, and, I've been doing the podcasts on how value investors can really buy Facebook. That was kind of a key right there, that when I was talking about yes, you can get into some of these growth names. And I've done a lot of podcasts on value stocks that have growth and how to get in those. And that's all been good. And we as value investors have been able to find some growth stocks actually that are still values that we can buy. But when are the true areas of value going to shine? And interestingly, over the last couple of weeks, there seems to be a little subtle change in what's going on in the market. Value has actually outperformed, at least since June, so only a little over a month now. They've outperformed by about 3%. The value ETF is up about 1%, and the growth is down about 2%. And that's because FANG is down considerably. And FANG is a big percentage of a lot of the large cap ETFs now. And people have been selling out of FANG and rotating into other areas. There's a few value areas that have suddenly moved higher in June and now to start July. And that includes the banks. Energy and retail, still down in the dumps. We've talked a lot about those. But if the banks make another move higher, which we did see after the election, we saw a significant jump then, and then they've kind of gone dormant in 2017. But if we can see those move higher, we could see something different for value. So the value investors, it's been a hard road for the last 2.5 years, but I do think the change is coming. I know I said that after the election, and it did look like we were finally on the road to value coming back to the fore. And then that was squashed down basically starting in 2017, as I said. But I do think that something might be happening here. And the last month is only just a month, so it might not this might not be the turn. We won't know until, numerous months into it. But all is not lost. And I feel like at least value's starting to make a little bit of a comeback here. And if that's true, of course, we want to be asking what stocks should we be buying? So I did a basic screen for stocks with PEs under 15, which, as you know, is my key level for value, especially with the overall S&P 500 much higher than 15 now. I think it's near 19. So 15 is pretty cheap compared to the overall market. And I looked for Zacks rank of 1 or 2 because I want those rising earnings estimates. Now, with that Zacks rank of 1 or 2, that means I'm eliminating most retailers and energy from the group. Not all of them, but most of them, because they do not have the good ranks right now, as we've talked about. Most of them don't have the rising estimates. They're going the other way. So it's going to eliminate most of those. But I was surprised at what I got when I screened for this. And there were 217 stocks in there, and they did seem to be in certain groups, some of which we've discussed in the past. So that's not surprising. But these are some areas that you're going to want to keep in mind if you are trying to build your value portfolio now ahead of this turn that ultimately we will see. I don't know when, but hopefully soon, but we will see a turn back into value. So the first area was the home builders again. And I've covered this extensively over the last 2 months because the home builders actually outperformed tech over the first couple months of the year. And I still like them. They're still cheap. So I looked around. If you want just a general home builder stock, I would go with Pulte, which is ticker PHM. They're one of the largest home builders, which is why I like them. They're basically in every market, and their price point isn't super high. So they still are somewhat affordable. They trade with a PE of just 11 still, even though the stock has moved higher quite a bit this year. So I still like them. We've already heard a couple reports from several home builders, including Lennar and KB Home. Both Lennar and KB were much better than expected, and both had big backlogs and like a gain in orders, like that, the biggest gain in over a decade for these home builders. Now, they are having some issues with labor costs and even finding enough construction workers, and then the high price of land. But demand is there and people want this new product. So I really do like Pulte. I own KB Home in the value investor portfolio. And I was looking around at Lennar. It's a number 3 right now, but it only trades at 12 times. So it's cheap too. And there's a couple other ones. There's Toll Brothers, there's Meritage, there's a couple others like kind of smaller end. So if you're just looking for one that kind of encapsulates the entire U.S. housing market, then I would go with PHM for right now. So looking beyond the home builders, though, of course, there's the semiconductors, which is the area we were able to get into as value investors that was also big time growth. Micron, which is ticker MU, just reported, and I've talked about them in the past. They're still cheap. They're only trading at 7.8 times. I mean, that doesn't get any cheaper than that. But it looks like investors are starting to rotate out of the semiconductors, even though the cycle isn't yet over and the growth is still there through the end of the year. So this is an area where, while it's a value, you may not want to get into it right now because of what's happening with growth, because this is a value/growth area. And if people are selling out of the growth, they're going to go into the more traditional value areas, and semiconductors usually aren't really traditionally value. But if you're interested in still playing the growth and you think that that still has a while to play out, then I do still like Micron. That's ticker MU, like I said. We've talked about the airlines a lot too, and they all still have good ranks. They're all still pretty cheap. Not historically as cheap as they've gone, but, with fuel prices still low and travel demand is still up, the consumer worldwide feels pretty good and they are traveling. So keep some of the airlines in mind. I was looking around at Delta, DAL. Their PE is just 10, but there's others out there. I've talked about many of them over the course of the last 6 months. So the airlines, a couple of them have pulled back recently. There may be some room to run still for some of those, and they're not super expensive historically here. So take a look at some of the airlines, and then there's Delta, DAL. Now, the health insurers showed up on some of my screens, And I was kind of surprised by that because they are at all-time highs, basically, and they're not that cheap compared to the overall market, but they are kind of when you add in their growth projections. So I looked at UNH, they're trading at 19 times, Humana's at 21 times, and Aetna is at 17 times. So not super expensive, but not what I would historically look at as cheap. But shares are still surging despite the uncertainty with what's going to happen with Trump Care and the mandate, because everyone thinks that the insurance companies are still going to make out one way or the other. They're doing really well under Obamacare, and many investors think that they will do really well under any new regime that comes in as well. But I would look for them if there's any kind of pullback there. These have been traditionally a value area, but right now, still a little pricey, so I'm not sure I would be diving in right here at these levels, but I'm going to watch that. Another area that is traditionally a value area is the chemical sector, and I really like chemicals because this is the building block, and as the economy heats up, these companies tend to do better, and right now, nobody cares about them because it's been all growth. But here's a couple names that you might want to keep in mind. Eastman Chemical, ticker EMN. They're only trading at 11 times. They're in chemicals, they do fibers and plastics. So they're cheap, and the estimates are rising there with Eastman. And then you have Westlake Chemical, WLK. They're also in like the specialty chemicals and the plastics and also building products. They're down in Houston and they have global operations. They are a little more expensive with a PE of 14.8, but that's not too bad, and also have those rising estimates. So there's a couple of chemical names. Keep on your list there, WLK and EMN. Now, I was surprised that there was really no domestic banks in my screen, and mainly foreign banks, which is fine. I do like some of the foreign banks right now, but I was surprised no domestic banks. And I looked at a couple of them. They're mainly Zacks rank 3s and sometimes 4s. They are reporting next week. I know, like earnings season is starting, and it starts off with the banks now. So we're going to get JP Morgan, Bank of America, all the big guys start reporting next week. That could be why the ranks are kind of just sitting around at 3s and 4s, waiting for those new reports to come in. So it'll be interesting to see what they say. I still do like the banks as traditional value stocks. I've talked about them in the past. I'm going to in the future too, because it's one of my favorite areas. But let's see what they say next week. This could be the time to get in those banks. And the PEs are good. I want to know a little bit more about like the overall business and what's happening with the big guys. And then I really like the community banks. It's a little bit harder to get into those individually because it's hard to know kind of what they're doing. Not many analysts cover them, but banks are definitely what to keep on your watch list. And I've been watching the railroads. You know, I'm a big fan of the railroads. And so is other value investors like Warren Buffett. He bought a railroad, obviously, for Berkshire Hathaway. So he owns his own now. But I like them, and those still have forward PEs that are around 20 or higher, so they're not coming up in my screens. They've been kind of down in their luck over the last, I would say, almost 2 years now, because volumes declined, and as crude shipments, crashed down, a lot of it was done on the rails. So they really lost a lot of business there. But things are starting to turn around, and they're seeing the volumes picking up in a lot of their key areas. So I like the railroads still again, and it'll be interesting to see what they report here. But until those estimates rise a little bit more, they have to rise a little steeper to get a cheaper valuation here. And some of the stocks have already started to move on the upswing. I know a couple are near 52-week highs, but the railroad's traditionally a value area. So I'm keeping my eyes on those. This earnings season will be key for many of these traditionally cheap industries. I'm talking about the building blocks like the construction companies, the equipment guys, chemicals, of course, and the rails, which I just talked about. So I'm going to be watching all of those. I don't think retail will rebound. It's still in the middle of this disruption with both Amazon and the online and the brick and mortar and who's going to win and all of that. The consumer is pretty good, but retail is still going to be choppy. So I probably won't be jumping into too many retailers. Energy is still lagging too until we get, significantly over the $50 barrel. If we do in 2017, that remains to be seen. So energy got some problems with those estimates. Value stocks, they may seem boring. That's why we were getting all excited about the semiconductors and all of that, getting into some of these other tech areas. But some of those hot industries, when they go cold, that's not so fun either. And the boring, it's like that old turtle versus hare thing. You take the slow road, and sometimes value, when it does start to turn around, looks real interesting. So my advice is to start filling your portfolio with some value names, ahead of the turn. And maybe it doesn't come for another 3 months or 6 months, or maybe even a year. We don't know. But it will come eventually. And as we've just seen, even in June, you did slightly better if you were a value investor versus the growth suddenly. So always have a diverse portfolio and make sure you play both ways and keep some value on the radar always, because eventually value will be the king and everyone will be saying that, talking about that hot chemical company. Yes, the day will come when people know Eastman or Westlake Chemical. And then even the banks, the much maligned banks, the day will come too when everyone will want to own Bank of America again in their portfolio. So keep these things in mind, and I'm going to be covering all of these value stocks and more during this upcoming earnings season so we can see what's happening with the value area. And in the meantime, you can also check out our older podcasts that talk about how to find the value stocks. Check those out on Zacks.com, of course, but also on SoundCloud and iTunes. You can listen to all of our old podcasts there, and I encourage you to do so because there's a lot of good ideas in there. And definitely check out the ones about how to find value with PE and using PEG and price to sales ratio. And I'm going to cover some of those again as we go forward, because if value is coming back in, we need to know how to find it. So be sure to tune in next time.